Hello, everyone, and welcome to the first Scientific Governance and Risk meeting of 2019. So this is a very exciting time for me because I've missed these meetings a lot. I feel like I'm losing track with what's happening at MakerDAO if we're not having a Scientific Governance and Risk meeting at least once a week. So happily, we're back at it. Steven, I'm going to hand it off to you and let you fill us in on the agenda.
No problem. Firstly, Happy New Year to everybody, and I truly wish you the best for 2019. What I'm going to do today is just quickly recap the last meeting that we had, but I'm going to just boil it down to one point, and that one point was, what do risk teams look like, and what should they do? And from our previous discussion, we went through the whole risk spectrum that could possibly be covered. And that's something that I will try to touch on today. But there is a very broad spectrum of which a risk team could cover the whole thing, or a risk team could cover something within that spectrum. That being said, I also refer to these risk teams as those that support and those that submit. Now, that was a little bit of a misnomer with respect to the support, because effectively both risk teams should submit. And this brings us into the conversation for today. What are supporting teams? Who are they? And even more importantly is, if they're supporting, how should they be compensated? So let's start at the beginning. So what do I mean by supporting risk teams? Well, these are the guys that do, I'd say, non-specific risk parameter things, like they bring in the data, they do the data cleaning. You could find that they'll have a model validation service. You could have basically just a provision of quantitative and qualitative data. They could provide things that we haven't even touched on in previous calls, such as recourse audits and technical audits. So I'm going to stop there for a second and just see if anybody's got questions on supporting teams, because I think this one is going to be the interesting topic for today, as opposed to the submitting teams.
I don't know if I have a question about, I don't want to jump ahead because I
Sure.
do that, but one of the things I'm interested in is what a recourse audit would entail. Does that mean that somebody would, they would buy a Digix token and then fly to Singapore to see whether they can redeem it or not? Or what does that mean?
Precisely. The recourse audit would cover everything from physically doing that all the way through to the legal aspects of it as well. The one thing that we have to keep in mind is that going into 2019, it seems to be the year of the security token. And the security token is either going to be a representation, very much like a share, of an organization, or the security token is going to be a representation of an actual security. Now, keep that difference in mind. Keep those two aspects in mind. Now, given that you use it as collateral, and given that a CDP is liquidated, and you try to liquidate the underlying collateral, you can either obviously go into a different sort of liquidation vector, like you could use the collateral and go purchase ETH, or you can use collateral and go in and purchase DAI, whatever the case may be. But if everything fails, it boils down to, well, how do you go back to the issuer and claim against them? Now, we need to be able to boil that down to the granular level of, someone has done an analysis and someone has found that this is the path that you should take. So very much like Richard says about Digix, if you do have Digix collateral and you want ultimate recourse, it really does entail you traveling to Singapore, presenting yourself. Then you get this little gold bullion, which is this tiny little piece of gold, which is actually pretty cool. You should go into their site and have a look at it. And but that doesn't end it there, because all that's done is giving you gold into your possession. Recourse audit would then illuminate the reality that just because you've got gold in your hand doesn't mean you actually have a full liquidation, because you still need to turn it into, unfortunately, Singaporean dollars, not just US dollars or euro or pounds. Now, how do you do that? Because as soon as you get that gold into your hand, you've taken it out of the integrity process. Now you have to get back into the integrity process, which means that you either got to submit that gold back in if you wish to use it again within the token construct, or you simply have to go to a designated broker, which is very important, and be able to sell that gold directly to them. Now, I don't know if any of you guys have tried this, but taking a piece of gold in your hand and walking to a broker's office and saying, I want to sell this to you, not that easy. You really have to make sure that your paperwork's in place and everything is very well documented before you can present that that bullion to liquidate into fiat. So these recourse audits are going to require legal teams. They're going to require folks that really look into this, especially when we consider non-fungible tokens. What about invoices? What about other possibilities that could be turned into non-fungible tokens? Or if you have a collection of non-fungible tokens that have been made fungible and you use that as collateral as well. It kind of goes into the same spirit as the and how everybody's probably more than aware of on this call. It really boils down to a couple of things. One, we are looking for ERC-20 compliant tokens. Is it in fact the case? Then you go further to have a look at any sort of operational risks that lie within the coding of the token itself. But I'm not going to bore you guys with that. I think you guys probably know that probably better than I do. But in effect, your supporting teams have to cover this wide spectrum of, call it verticals or risk verticals. And what we've got to figure out is, how do we vet these teams? How do they contribute? And how does that contribution get compensated? Because there's this idea that, you know, I mentioned beforehand, where you get a collection of risk teams working together. It may work, but ultimately you might find that compensation really is in the hands of the person or the team that submits the risk parameters, and then it's all about negotiation in the background. That might work, or that might break the system. I'm not too sure. There's another avenue where, if you're a supporting risk team, you actually submit what you are, you submit the data, or you submit the work that you have that actually supports all the other risk teams that wish to actually generate risk parameters for the system. So how do we go about doing that? As an example, you have a support team that gathers data, cleans it, and provides it to the system. How they compensate it? Should we require them to have the data made available to everyone, open source? Or do they keep it for themselves and then interact with the risk team that actually submits the parameters at the end? If so, what are the economics in there? How does it work? And what's the sort of dynamics between the teams that try and provide the risk parameters at the end of the day? Okay, I feel like I said a whole lot there. I'll stop for a moment to see if there's any questions.
That might be a good opportunity for me to remind everybody. I forget to do this at the beginning of the call. If anybody has any questions, please feel free to jump in at any time. We actively encourage it. Don't consider it an interruption. If you don't have access to a microphone, type your questions in the chat at the side of the window, and I'll read them out when there's an opportunity. Steven, one of the questions I've had, and stop me if I'm jumping ahead, but I'm always kind of curious, or I'm having trouble wrapping my head around, where do risk teams come from? Or is this a concept that already exists in the financial world, that you can go to company X and they have a risk team internally? Is that what they call it? Or is this something that we're kind of inventing in the crypto space?
Oh no, there's nothing new about this. Everything to do with risk is really old hat. It really is a case of taking the traditional tools and applying it to the space. But obviously we need to tweak it appropriately, and we need to add in a few dynamics that are, clearly not present in the traditional space. Number one, the most obvious one, is a decentralized risk function. That is, I would say, to my mind, unheard of. That's the one thing that we're truly innovating on. So that requires consensus. That requires the ability to figure out how to make this already particularly difficult function in the traditional world function in our world by firstly splitting it up into component parts that everyone understands, and then sort of abstracting it into a general application that works. In the traditional world, there's something called enterprise risk management, which literally says take an organization and look at every possible risk thing that could happen to it, a risk event that could happen within it, and try and manage it. It is a massive subject matter, and it really entails going down to the details of processing transactions, what does it look like, how to audit it, how to verify or validate it, and so on and so forth. So the tools are there. It really is a case of bringing it over to our space, using the tools that work now, and then eventually seeing how we can expand this to bring in the rest of the tools, obviously with the innovation for our space included.
Are there agencies that can be contracted to do this kind of thing?
Absolutely. There are, from the big four auditors that have their own departments for risk management, all the way through to independent companies, all the way through to large financial institutions and even investment banks that outsource their risk management function. It is absolutely everywhere. And you find that the processes that are defined within these big institutions are extraordinarily detailed, and they are, well documented. It would be great to see someone in that space take that massive process and try and bring it over to our side and actually try and implement it. And that is effectively what I'm trying to do. But there is so much of it that if I had to basically just drop it all right now, it really would be like a ton of bricks on top of our heads. And most of it wouldn't really be applicable because we're not at that breadth and depth of economy or of market to be able to use all these tools. The granularity is absolutely, massive. To a certain extent, it's actually quite interesting and ironic. The granularity has been taken care of because of the immutability of the blockchain. And it really sort of boils down to grabbing that data and repurposing it for a risk management function. And in doing that, you can really enlighten yourself as to how your organization is functioning, not only within itself, but within the actual blockchain space as well. We are in a much better position to really suck out more value from these traditional tools than folks in the traditional space. I feel like I've used the word traditional far too many times now. So that effectively is a rundown of the supporting teams. As I mentioned, what do we do with respect to the data they create, and how do we basically compensate them appropriately? Now, I don't have the answers here. I mean, I've got ideas, but I certainly don't have the answers. And this is something that I'm sort of putting out there, and folks need to chew and think about this and come back to us. But if you are a risk team that sources data, cleans the data, and makes it available, the one thing that the MKR token holders or governance needs to do is vet that process. Where are you getting the data from? How are you cleaning it, and how are you providing it? Now, what do I mean by the provision of data? Is this data, and this is the detail that we need to really think about, is this data centralized to this one risk team, or is this data made available in a decentralized platform like IPFS or what's the other one, Storage or something like that, where everybody can have some sort of accessibility to it? I'm not sure. Now, given that, you'll find that submitting risk teams would say, well, that's fantastic, I would use it, and then they would use the information, create the models for themselves, the They would create the models for themselves, use the data, and obviously come out with risk parameters that they would contribute towards the system. Now, their submission is very clear, and therefore the compensation would be very clear. But what do we say about the guy that submits, or the risk team that submits the data? What do we say about their contribution? What do we say about how they get compensated? Is there a fixed rate process? I think, Rich, you mentioned this in the previous meeting. Is there a fixed rate process? Is there a compensation per submission? You know, what is this economic that's going to make this work appropriately? Now, as I said, I have ideas, but I want to put that out there for, you know, folks to contribute and you know, sort of give some suggestions. But that is one aspect, the data infrastructure. What does it look like? Not just with respect to quantitative data, but with respect to qualitative data. One aspect that we definitely need is qualitative assessment. So you might have risk teams that do this qualitative assessment. So generally you find that those teams are proficient at getting the data themselves. Now, in order to vet the way they produce assessments, should they disclose their data as well? Should that be outsourced, or should that be centralized to themselves and they just produce assessments that are directly used by you know, the more quantitative risk parameter submitting teams? There's a lot of permutations that, you know, one needs to consider, and there's a lot of outcomes that one needs to consider now. And really, what I'm trying to do right now is elicit a lot of thinking and processing around, you know, what would be the best way to do this. I have you know, a couple of ideas, but I think this particular meeting can be the starting point or catalyst in how to bring them all together. And what I'm going to ask is that if anyone does have any ideas, feel free to drop an idea, feel free to email in. You know, anything is welcome. Now, the other aspect, which is also important, is you have all these risk teams, and they're all contributing. Now, let's pretend we've defined very well how they contribute and where all this data is stored and how this data is accessible and who can use it. How do these risk teams communicate between each other? How do you communicate in a way where you have open dialogue that is transparent to the community to understand the call of the mind of the risk function? Do we need to centralize that communication? Do we need to provide a platform? Is that platform going to be next to the weightings that are submitted to the risk teams, where we aggregate the consensus on the risk parameters? Again, this is, you know, obviously a very important aspect to consider. So again, I'm going to pause there for a second to see if there's any digestion that is required.
Well, maybe I'll jump in. So I'm thinking about how we would do something like that, because you've always been very, very careful to be upfront about the things we do know and the things that we don't know, and the things we need to figure out in the future. But the future is kind of sneaking up on us. So what kind of mechanisms are we going to put in place to start gathering that kind of feedback, or I guess kind of really solidifying what the risk teams would be like? And if people were interested in becoming a part of a risk team, who would they go to, or what are the barriers to entry, things like that? Like, do we have sort of any thoughts about what a process to get this thing kicked off would look like, or do you have something kicked off in the background that we're not aware of?
Oh no, that's what I'm doing is, you know, purposefully eliciting a lot of thinking with respect to how does one become a risk team. You know, what are the things to consider? Because the more, what I'm hoping is that the more I talk about this particular topic, you know, and split it down into its granular form, you might find there's one aspect that resonates with someone. And that person or that team will go, oh, hang on a second, we could quite easily do that. In fact, we might be able to create a business off the back of that. Now, going about forming a risk team, going about contributing, we, the internal risk team of the foundation, purposely going to be the model. And we're not going to be the model as, or rather in terms of the benchmark of the best kind of risk management in the world, because that's, you know, impossible. That requires a hell of a lot more resources than we have. But what it does do, it gives a very well-defined path on how you become a risk team, how you get vetted by the community, how you get included into the system, and how you go about contributing towards not only the data, but the data models, model validation, and risk parameters as well. I mean, the whole thing is very much inclusive. So the sneaky part about this is that now I'm trying to put out there the idea in everyone's minds that anyone can be a risk person or risk team. It really boils down to what you want to contribute, and really what that is going to look like is, well, follow the internal foundation risk team and see how they're forming and see how they are sort of contributing towards the system. Now, there's one aspect that I didn't speak about, or rather one group of risk teams I didn't speak about are the submitters, the guys that actually put forward models. Now, we've been harping on for the longest time about collateral models. Now, put forward a model so you can calculate the risk parameters for this particular token. Very simple. But what we are missing are two more groups of models, and this I haven't touched on yet. And for the new year, I think this might be another new subject matter that is open for discussion. The one is portfolio models. Now, we've been speaking about collateral models and understanding them, but what about the portfolio as a whole? We obviously need folks to look at the model and say, well, the collateral portfolio we have has contributed so much stability to the system. How is that quantified? What does that metric look like? What is the diversification benefit that we have achieved? Can we actually create more? How does this intersect with the business needs of the system as well? The other set of models are the sort of economic models. I mean, as you've probably witnessed, and this might be actually a segue into another discussion, we've recently decreased the stability fee. Now, there's a lot to be said about why that happened, what's the rationale, what does it look like going forward, how do we actually rationalize these increases and decreases, and what does it look like in terms of a model? Well, that's one other aspect that a risk team contribute is an economic model. It might be on a case of saying, well, we've studied the space, and we've noticed that there is a massive glut of inventory. That means we need to increase the stability fee. There is, a massive demand for it, but not enough supply. Well, we need to decrease the stability fee. What's the model behind that? Where's the data coming from? The processes are very easy, but it's the data and the empirical justification for it that's a little bit more difficult. So there are two other aspects that I have never touched on before. The one being is the portfolio models and the economic models. And together with the submitting teams, specifically recourse and technical audit, this starts fleshing out the full scope of what this spectrum should start looking like, especially when it comes to the rubber hitting the road, because that is where the system as a whole functions really well and functions purposefully. So I shall pause there one more time. I think I may have started this session with more like an avalanche of information than I have previously. So if there's anything that you sort of wish me to go over again, I'll be more than happy with. If folks think that this is slightly confusing, I'd be also happy to elaborate on any point. But that, for all intents and purposes, is what we are going to look at and what we're going to deal with this year. And you're going to find that the risk function is going to come front and center a lot more than it has in the previous year. I think we were setting the stage and the foundations for it. Now we're going to start implementing it. Now we're going to start answering questions like, how do I become a risk team? How does one submit risk parameters? What does the data look like? How do I submit the data? and then at the same time, not only asking questions, but maybe even providing answers, such as I would like to submit data to a centralized storage function. I would like to create a qualitative assessment model that includes certain traditional aspects, and so on and so forth. A lot of it is going to be from a dialogue that I hope that we can start in earnest, either on Rocket Chat in the sort of collateral and risk, the public collateral and risk channel, or in Reddit. But I leave that to Rich to tell me which way I should go in that one.
Well, I was actually thinking about that just a few minutes ago when we were talking about what the actual mechanics look like and when things get started and what the parameters are. So, and when I was talking about how you kind of throw things up to the community for answers, and I guess the sense is, when should we start thinking about aggregating that data in earnest? So, is there a rough roadmap of what the risk teams are going to look like and how they're going to evolve over the course of this year, or is the first step to start reaching out to the community and getting that kind of feedback?
Oh no, I'm doing this all in parallel. I've got my plan in place that I'm going to go forward with, that actually looks at the data analytics to qualitative and quantitative assessment. That is coming into I suppose it's coming to fruition in the sense that all the stuff that's been written, discussed, is going to become more open in terms of how to actually go about doing calculations, what the underlying idea is, and so on and so forth. That's going to be the first thing that comes out. The third article that was submitted on risk governance looked at the broad application of governance, but I did mention at the bottom of that article that there's going to be, I wouldn't say a technical submission, it's going to be a submission with some math in it. It explains how we go about looking at a portfolio of collateral and understanding the application of something called liquidity adjusted value at risk. That's it. So it's going to be simply a look at that, where folks can read that, process it a bit, and probably come up with better ideas, or effectively just try and implement it themselves in Python, R, or whatever the case may be. But this is a two-track process. I'm certainly not waiting for the community to come back with ideas first and then respond. It's going to be definitely parallel, because I'd like to get the dialogue going. I want to get the conversation going. And in order to have a conversation, we both need to have very strong opinions about how we should move this forward. So internally, we have a very firm foundation of what we'd like to do. But now it's going to be a case of saying, well, we've spoken about this for a while now. Now it's almost like the community's turn to say, okay, well, this is what I would like to do. And then we start bashing ideas together until we actually, almost through dialogue and debate, make clear to the community what the process looks like. Because I find that if you just list the process and you say, effectively it's a simple step 1 to step 10, and that's how you do it, it seems like a good idea until you try doing it, and then you realize that there are a lot of nuances. And to try and figure out all the permutations of the nuances it's almost impossible. You'll stall the whole procedure. But if you do it together and you actually discover the nuances together, the ones that we already anticipate and even new ones that we didn't anticipate, you can move through these steps until you get to a final conclusion. And you've done that organically. You've done that organically, and you've involved the community, and you've got a better sense of how you're actually addressing not only just risk, but the stability in the entire system. Because this is a very holistic problem. It doesn't just boil down to what's the risk of this token, I stick it into a collateral portfolio, and that's where it ends. It talks to everything. It talks to the dislocation of supply and demand. It talks to, stability fee setting. There is a much broader aspect. And we need the ability to work cogently as a broader team including the community, to understand fundamental aspects of tokens that we in the foundation may not understand or may have missed, all the way through to really cool ideas with respect to creating a collateral portfolio and managing it appropriately. I pause there again for a second so I can catch my breath.
Okay, I'm not sure that we're going to have an avalanche of questions in this call. I think people are still ramping up after the holidays, so
that's fine.
Where's
David?
He was in at the very beginning of the call. He just finished a 20-hour drive to get back home. So.
Oh, good God. Okay, well, understandable. Okay, so then if there's nothing further, then I can just have a look over my topics that I wanted to cover. It was supporting teams, just to revise on that, guys that provide quantitative and qualitative data. That's also, when I say qualitative data, I'm talking about all aspects of data that allows for risk assessment. You can have a risk support team that looks at not only data cleaning, but validation services, model validation services. That's actually quite an important aspect as well. It's all very well for folks to submit models for MKR governance to consider, but you might find that there's very few people that can actually, work that model appropriately to its finer point. You may need some sort of validation service. Recourse orders, as we mentioned before, they're actually very important, especially coming into the new year with NFTs that are going to come on board. You're going to have security tokens that come on board. The whole tokenization of securities, the whole stack, we have to get our head around to understand how that is actually going to not only apply with respect to that particular industry forming, but also with respect to how collateral can be used within the Maker system. Technical audits, you guys know better than I do, so I'm not going to go into too much detail there. As far as the the teams that are submitters, we've always spoken about collateral models, but I'd like to start stretching everyone's mind into portfolio models and economic models as well, because all of this comes together. You'll find that as we progress, it's going to be pretty obvious that certain things need to be addressed. You start off with collateral type, you realize you need to look at the portfolio. You start at the portfolio, you realize you need to look at the system. You look at the system, you realize you need to understand the economics of it. So the thing really relates, even if you think that all you're doing is calculating a simple stability fee for a collateral type or a simple debt ceiling for a collateral type. But in fact, what you're doing is implementing a parameter and or feature that actually affects the whole system.
That part I find especially fascinating, is the portfolio management. What are some of the things that you're looking at, what your risk team look at if they're taking a holistic view of all the different collateral types and somebody proposes a new collateral type? Is it just correlation, or is there some deeper relationships that need to be considered?
Well, this is where the innovation comes into our space specifically. From the traditional space, it was very simple. It's a risk return optimization calculation where you've got expected returns, expected risks. And note I use the word expected, which means there's a statistical element to it. And then obviously you have your expected correlation matrices, you apply it and you do all the necessary math, and you come out with an allocation to the stocks, and you slowly build your portfolio. Now, very much like in the traditional world, the math, everyone has got their head around. I wouldn't say it's easy, but everyone's got their head around and it can be applied. But what is difficult is actually implementing the path to constructing your portfolio, because things are not going to stay still for you so that you can go quickly get them and put them in your portfolio. If you think of a large mutual fund that decides that it needs to allocate $5.5 billion to Apple, it's not going to go into the market quickly and purchase $5.5 billion of Apple. It's going to do it very slowly because it doesn't want to affect the price. This is where the liquidity adjustment comes into consideration. The same with us. We have a portfolio of collateral, and we've got 3 types of debt ceilings. The broader debt ceiling, the theoretical debt ceiling, tells you, well, if everything was good and the whole world was great, how much could we take of this particular collateral type? But in order to get there, we've got to be practical. We've got to have a look at it. We have to consider it in terms of its market cap. We've got to consider it in terms of its liquidity. We've got to consider it in terms of its price volatility. And then on top of that, and this is where it really becomes innovative from our particular space, we've got to consider it in terms of its business function, its economic function to the remedy of any dislocation between supply and demand, or the further provision of supply, and if you believe in sort of supply side economics, to actually spur demand. So there's so many aspects about the traditional space that we've taken into our own space, and we have to sort of meld them together so that we actually create not only a risk management mechanism, but a business development mechanism as well. So it's the risk mechanism, the business development mechanism, and an economic mechanism at the same time. So that's what a portfolio construction from our point of view looks like. As an example, if we decided that, I always like to use Digix because I think everyone can relate to the fact that it's gold. If you have a look at the theoretical foundation, it's gold. So therefore, people would think, well, there's gold. It's pretty darn liquid out there. You can do anything you want with it, and there's approximately $9 trillion of supply, swishing around the world. So we can have this massive debt ceiling. That's true, theoretically speaking. Practically speaking, the people that provide this, the organization provides this, Digix, has, I stand to be corrected at this point, but they've got about $3 million worth of the token. So here's where you have a look at the practical aspect of it and say, well, 3 million is the market cap of this particular token. Even though it does represent gold, that is a $9 trillion supply out there, we can't consider it from a theoretical basis. We have to look at it from a practical basis. Even when we look at it at the practical basis, we can't say, okay, let's make the debt ceiling 3 million. We can't, because that's their full market cap. We then need to consider, okay, well, what portion of it can we consider? And that comes down to, what sort of liquidity aspects you want to be subjected to. Now, why am I talking about this? Because we have referred to this before. We're looking at this because we need to balance the fact that there is a difference in correlation that is required, but there's also a business reason as well. To be able to include Digix might be able to facilitate a bootstrapping process to get Digix being used more. So you have the ability to actually catalyze it, or have the ability to catalyze it. And you might find that Digix grows from 3 million to 10 million within the month just because it's entered the Maker system. So there's that business element as well. And that you have to not only cater for, but you have to manage as well.
Does that represent a risk to the MakerDAO ecosystem if the value of an asset type is primarily derived from the fact that we're using it?
Well, to a certain extent, we will always have that contributing factor to a token, because we provide two of the primary functions that drive all economic systems: the ability to pledge collateral and the ability to draw value. That pretty much drives everything. So if you've included this within your ecosystem of your token, you naturally are going to be able to capture the liquidity premium, and at the same time, you're going to be able to get a source of financing for yourself that was never before available. So these two aspects are going to always play into an organization's thinking. And to that end, it really boils down to how big that organization is. I mean, if we have a very large organization that we use as collateral, like right now, Ethereum, to a certain degree, we do contribute, but I don't say we are the primary factor towards the Ethereum success story. But I reckon give us a little bit more time and we'll be one of the primary factors to the Ethereum success story. You're going to find that, for me, Ethereum is, every time I read more about the details of it, and, I must confess that my technical aspect is not terribly strong there, it invigorates me to the point of realizing that this is a unique network that has the ability to facilitate a completely different economy that will just dovetail appropriately with the traditional one. And we are the de facto primary functionality to help drive a financial ecosystem on top of this as well. So that being said, we should, given the success of Maker, be able to drive pretty much a lot of value on at least Ethereum for now. When interoperability becomes more accessible, who knows where else as well.
I'm just trying to figure out how that, what a corollary in the traditional market or the traditional financial world would look like, because MakerDAO kind of, we occupy kind of a lonely spot in the ecosystem right now. There's us, and I think Compound sort of does something kind of like what we're doing. But if a token XYZ comes in and their value, we accept them as a collateral type, and because of our acceptance, their value doubles overnight. And then it comes time for something bad happens in the market. We need to liquidate a bunch of CDPs. Would there be this accelerated sort of devaluation of that token if the prime or significant amount of its value was derived from the fact that it was a collateral type, but it's no longer a good collateral type? Would that cause it to nosedive even more quickly than it would have otherwise?
Well, if your risk management is not particularly good, yes, you'll contribute towards that. And there is in the traditional sort of finance space, you've got a lot of small cap companies that go to banks for financing, and they do use their own stock as collateral. But you've got to keep in mind that you might find a small cap company is, let's say, $50 million. They're going to pledge $30 million for like $2 million or $3 million worth of finance. They're going to have a sort of a major buffer for themselves. But at the same time, this is where recourse comes in. Before the bank can actually do anything for this particular company, they're going to go through the recourse material. They're going to go find out how they can, assess the assets, look at the ability of recourse directly to the assets, or even be able to take the stock itself and find a buyer of last resort. And
so ultimately, a small cap token added to our system, you'd factor in the liquidity risk.
Yes.
Upfront, knowing that it could potentially get a MakerDAO bump after it was added into the system.
Yes. Okay. I mean, that's the thing. Let's say, for instance, we get someone that is, let's pretend for a moment, not that I would include someone that has a 10 million market cap. If they get included, it bumps up to 30. Now, consider this for a moment as well. We've got a debt ceiling on this, and you might have, let's say, exposure to, I wouldn't put past 4 or 5% of market cap. So that bump would basically turn into 15% of our original use of the debt ceiling. The point there is to always keep the assessment going, to always keep the analysis on the token and the organization going. That is the competitive edge. That is where the thing works, is that very much like our governance or the executive component is based on continuous approval voting, so should the risk management. Should be a continuous assessment of not only the token construct, but also the organization that represents it. Because
I was just going to say, it sounds like an enormously complex and fast-moving sort of algorithm needs to be balanced. But I think that's because I made the mistake of thinking that we're only going to be supporting ERC20s in the future. And I think that that's a very, kind of unpredictable, very fast moving, kind of irrational market. But with a focus on real world assets and the tokenization of, real life, that kind of correlation risk obviously goes way down, and that kind of
you would think
tweaking of debt ceilings, right?
Yeah, you'd think. Here's another little sort of thought process to keep in mind. There's something, obviously, when you have a look at, I don't know how much you guys would know, but if you have a look at the futures market, there's something called the basis risk, which effectively says, well, what is the true difference between the futures that you're using to hedge out your underlying commodity? Now, there is this little risk, and that risk is representative of how people are trading in the market. Now, the same thing applies, to us. We have to have a look at what is the basis risk between the token that represents an organization and the organization itself. You might find that, like an exchange-traded fund, even though by construct, you might have the exchange-traded fund move away from its fair value during the day, but ultimately that fair value needs to be realigned to the price by the end of the day. In our sense, if we don't have that mechanism in place in the securities market, you might find the token is completely dislocated from the organization's value. You might find the token is all over the place. It may have more volatility than the actual organization's security has. So let's say, for instance, we do something like tokenize Walmart. So you'll have a token that represents Walmart, and you have a security that represents Walmart. Theoretically, they should be in lockstep. But the problem being is, you've got such different markets, you're going to have basis risk between them. You're going to have slight difference. And people are going to try and arbitrage that difference. It all depends on the ability of transferring the necessary script versus token to realize that arbitrage. But where that becomes harder to do, when that friction increases, you're going to have a disparity between the token, what it represents, and the security and what it represents. So that's why when I said in the beginning, your security token may be an actual representation of an organization. In other words, an organization forms and then offers actual tokens as opposed to script. That's one version. The other version is folks have script, and they just use that script and turn it into token. They might pledge it and have token, or they may basically just store it and produce new tokens on it. It depends. But that method produces a little bit of basis risk. And that you've got to consider as well. Because it's not always straightforward. It's not always a case of, oh, look, Walmart is going to be, a wonderfully uncorrelated asset compared to ERC20 tokens. But as soon as you turn it into an ERC20 token, you might find that it captures a lot of the correlation of the ERC20 environment or industry. The hope is that it doesn't. The hope is that what it brings in will start creating assets that are completely different from the ERC20 environment. It sounds a little bit out there, but you've got to keep in mind that you have to have a firm representation of what that token looks at in terms of value to be able to ensure that the risk profile, being the correlation profile as well, actually traverses into the token and into our collateral portfolio. So the devil is always in the details and in the nuances. So we've got to be very open to the fact that it's not always going to work out the way we wish. But I think that once it does have critical mass, we will get there really quickly. I want to take a breather.
All right, we're coming up on 9 minutes left to the top of the hour. If anybody has any questions about anything at all, please feel free to ask. One of the things, I think maybe this touches a bit on what you were just discussing, Steven, but it's a question that comes up in the community every so often, and that is, will MakerDAO ever consider having an asset class of tokens like the ones that DYDX offers? So short tokens. If someone wants to go long or short on a certain collateral type would we consider offering that as or accepting those tokens as a collateral?
No matter what token is considered, it always boils down to recourse. Ultimately, you can have a derivative-based token. You could have really a compound token of others. As I said previously, you could construct a fungible token from non-fungible tokens and have that submitted as a collateral type. Ultimately, the acceptance of it boils down to the ability to recourse all the way back to a final satisfaction of an event, some sort of liquidation into fiat, or some sort of liquidation into a more liquid token. Now,
okay, that makes sense. I think I'm falling into the same trap that a lot of people fall into when they think about the collateral types, and that is, does X work? And generally the answer is yes, if there's liquidity, if there's recourse, and if there's reasonable risk parameters placed on it. Of course, anything can basically come in. It's after it passes all those hoops, I guess, what's the utility of actually having that token in the asset class? Because it could potentially have reduced that to, minuscule amounts of debt ceiling.
Yeah. Okay. I mean, the one aspect that is going to become extraordinarily important in the system is how deep this risk rabbit hole goes. Because anything can be accepted as a collateral type, anything. It just so happens that right now we're using price discovery as a mechanism of recourse. In other words, your ability to go and sell something into an open market, which then behooves you to think clearly about what an open market is. And at the same time, how you would define one, and what type of market you want to be able to interact with. In other words, what's liquidity? Is liquidity real? Where does it come from? The distribution of players and the distribution of incentives in a particular market needs to be diverse enough to make that liquidity sustainable. These aspects have been looked at in the traditional market for the longest time now, in developing markets, creating markets, and sustaining markets. And your market makers there, be them specialists or, specialists on a stock or specialists on a security, or just a general market maker, you'll find that they are very cognizant of the distribution of players in the market. As an example, you find that a lot of movement is going towards your sort of algorithmic, well, actually, I'd say predominantly 70–80% of the action in the traditional market is algorithmic. So that means you've actually reduced the number of players that you have in a theoretical sense, because you don't have a disbursement of people all phoning in the calls. It's now being sort of abstracted into teams that represent specific algorithms, or teams that represent specific robo-advisors. And those robo-advisors and algorithms, you may say that there are like tens of thousands of them, but basically you've reduced it from hundreds of thousands of participants down to tens of thousands of algorithms and effectively computers. So that affects the way market makers work, because now they realize that at any one point in time, and this is effectively what the flash crash was in, I think, 2010, was a whole bunch of algorithms all agreeing at the same time. Like, we all need to sell, and they sold. And they didn't keep in mind all the risk parameters, didn't have enough latent, didn't have the reduction in latency to pick up the fact that the market was crashing, and they should maybe, flag a human being to say, maybe you just need to ride this one out. None of that ability was there. It was just a massive supply that came in, crashed the market for a second, and then it revived, and someone switched off the machine and actually bought the stuff back. So, these are the aspects that you got to constantly keep in your mind, especially when you think about recourse, when you think about what we're doing and developing this brand new ecosystem and environment as well. Wow,
it's not going to be easy, I guess, is what you're saying.
No, not at all, but it's fun. Yeah, that's the thing. If it's not fun, it's not worth doing. The one aspect here is that, there's so many smart guys out there, and what I'm trying to say is that there is always, if you look carefully enough, a place to apply your skills. There is no avenue in the risk spectrum that says, oh, this is just for risk guys. These are just for mathematicians. This is just for this. It actually applies to anybody that is interested in understanding the process of generating a thriving economy in this new digital space.
Well, yeah, it is going to be a lot of fun, actually. And I'm looking forward to having some more discussions about how we begin to reach out to the community and start aggregating some of the ideas and interests that we've seen from some of our members and attracting more. I think would be a cool discussion for a future meeting, I think.
Absolutely.
All right, we have 2 minutes left. Were there any final thoughts you wanted to leave us with, or should we wrap it up?
No, I don't have any final thoughts other than you guys enjoy your ramp up to the new year, and I certainly wish you all the best for 2019.
All right, amazing. Thanks a lot, Steven. Thanks, everybody.
Thanks,
I'll be
guys.
posting the video soon on Twitter and Reddit and our YouTube, so you can look forward there. All right, bye-bye, everyone.